their untapped value in the US stock market. Hi, everyone. Welcome to the Market House. I'm Maggie Lake, and today I'm talking markets with Jim Paulsen, author of Paulsen Perspectives Substack. Hey, Jim, it's great to see you again.
You too, Maggie. Thanks for having me.
And welcome to everyone joining us live on Substack and YouTube. As always, you can drop your questions, comments in the chat. We'll get to as many as we can. Another record Monday. We feel like a broken record ourselves saying that, but we had the S&P and NASDAQ moving higher once again. It was chips and technology as it's been. Everyone talking about AI. With not too much movement with bonds. Yields were a little bit higher as everyone continues to see whether there's any progress in the government shutdown, and gold hitting a record. Seems like everything was up, which makes a lot of people nervous, I think, Jim. But so excited to be able to get your perspective on this because you worked in investment banking. You were a chief investment strategist for many years. You lived through the dot-com bubble. You've seen it all. Does it feel like history is repeating itself here?
Well, I think, Maggie, I think that history always does repeat itself. There's always remnants of things that you've seen before. But I also think it makes up brand new paths too that you've never seen before, all at the same time. That's what makes this business so fascinating and equally frustrating, because the great models that you used before that worked like clockwork, without exception, suddenly someday blow up and they never really work again the same. And every cycle has that in it, where things that work quit working, and you got to find new things that sort of pick up the slack. And so, yeah, there's certainly commonalities today that you see with past cycles. But I think there's a lot of uniqueness today, too, that we have not really dealt with in the past. And so you always got to be open to different possibilities and the outcomes, and not just get mirrored to things that you've used and that have worked for you all the time in the past.
Yeah. So how are you approaching this whole topic of AI? Because one of the things I think that we're hearing a lot of, and we saw it again with the AMD news today, is that, suppliers are taking stakes in their customers and the customers are buying from suppliers, and it's circular financing, or it's all just, a backdoor way of buying stakes in companies, but it all feels a little frothy and that maybe it's not real. How are you thinking about this sector and its impact?
Well, I think as far as buying up your suppliers and things like that, that's been going on forever. I mean, old line automobile manufacturers did that back in the day. And a lot of manufacturers, did that, compressed the industrial cycle, right? So there's nothing new about that. I think, I think that AI is like a lot of other technological advances we've had. It has incredible promise and possibilities, sexy to think about, and it can, if you think about it too hard, it can make you probably overbuy the stuff. Is what it can make you do. At the same time, it's got a lot of possibilities to not work out as well as people hope at the moment. And maybe it will work out, but it won't work out nearly as fast. Or maybe we'll find out there's a lot of other downsides associated with it working out fast. There's elements of that wrapped up in all that. But I would say this in technology in general. We've always had technology going on. There's no doubt. But I think the technology that we've had in the last couple decades or so is different in itself from what we've had previously. When we invented the airplane or the automobile, those things were colossal lifestyle changes for the world as a whole. But the reality is those things are basically doing the same function today that they did when they were first invented. Really not a lot of change, a little bit, but not a lot really. Where the stuff that we've been creating in recent decades has been life-changing, no doubt about it. But then within a few years, it almost changes its stripes into something else. Or it moves deeper into how it operates. So it's a constantly evolving technological innovation, as opposed to just inventing a new good or product that then is used forevermore. And I would say that's what I see that's really different from past innovation cycles. Maybe that's one reason too, while why this innovation cycle, in some regards, has sustained much longer than a lot of other examples you can think about, at least at the pace and the impact that it continues to have, in part because it's really new innovations that are happening all the time at a much faster pace than what we used to have. So I don't know where that leads, and I certainly am not an expert on AI and where that leads, and I understand or see some of the downsides of that. But I rather than pick one or the other, I think you want to maintain some investment in that general space of innovation, because I don't see that going away. I think that's a bigger decision than what you pick. And maybe it's a less riskier decision too, because you don't have to necessarily be right or wrong. You can be both and still come out over time. And that's kind of how I approach it, not being expert enough at any one subpart to really make a big call like that.
It's interesting when you think about it that way, and I haven't really heard anyone describe it that way. That this is not a product, but that's something that keeps morphing,
Yes.
onto itself, and is really. Do we have a way to measure that? Because you always hear people say these valuations are out of control, but if this is unlike anything we've seen, do the traditional ways of establishing valuation apply?
I don't think so. I think that, and I don't even think that's necessarily new to this particular cycle. What makes this technology cycle a little different is the sheer size of it in terms of market cap to the overall market. I'm not positive of this, but I think it's much bigger than what autos were when they first came out, or the airplane, other inventions, where it's gotten to be such a big part of the overall market in terms. Now, I would argue that that's not necessarily the case in the economy yet. It's bigger, no doubt, but it's not the overwhelming size like it is into market capitalizations, overall. But I do think that things are. You can either say the innovations are much quicker, or they just are morphing. You come out and you think about the gigantic IBM that was created, in the 60s, that took up warehouses and probably did what a little bitty calculator did a few years later. And then what we did with that calculator was we eventually put it into a bigger system on a PC that was much more powerful and could integrate videos as well as just numeric calculations. And then we took that and interconnected everyone's PCs, and then we gave everyone, their own IBM warehouse to carry around every day with phones, and we integrated, streaming and not just data, and just think it's basically some of the same stuff we came up with ones and zeros back in the 60s, but it's just morphed into something. And you think about adding in quantum computing or adding in AI or robotics, it's going to use all that same stuff, but it's morphing itself into completely different ways to think about it. I don't know if we've had that in terms of how fast it is changing all the time, and how life-changing every one of these things is. And I'm talking mainly in the business world, just changing the business world so much, so fast.
So do you see this? There seem to be sort of two narratives out there, and that's oversimplifying it. But do you see this huge CapEx spend, or at least commitment to spend? Because that's all it is right now. But do you see this as something that's going to end badly? There's a sense that it's kind of malinvestment, that it's people just throwing money at something without any idea whether it will generate a return. That's sort of what the sort of skeptics say. But then on the other side, you have folks who are saying, listen, we're at the cusp of amazing change, and all of this investment in AI, we're not sure who the winners are, but it's going to create this productivity boom that can really support economic growth.
Maybe somewhere in the middle of those. There are certainly far more fundamentals involved in what's going on today in terms of technology. It's a colossal fundamental success story. It's not like we don't have companies that don't have sales and don't have earnings, and aren't selling unit sales, at a tremendous speed. This is very different than like the dot-com mania to me. Dot-com mania to me was stocks that just had dot-com in their name. They had no real business, no earnings. They would escalate to incredible levels. I think most of the technology run today is companies that do have businesses, do have earnings, do have sales. Now you can debate, is the price in the right position relative to that, but at least they have them. It's not like all on the come. And I think that's a huge difference. I also don't see near the mania today that I did in the late 90s and in 2000, in part because I think it's spread across a much wider array of different technologies than it was more isolated on one thing that everyone knew about. I can remember going to one of the first baseball games at the San Francisco Giants Stadium when it opened, right there in 99, 2000. And I can remember going and sitting down, and the whole outfield fence was nothing but advertisements for dot-com companies. And I thought, man, why? This is like the barbershop, symbol of signal of a bull market top.
Yeah.
And I don't think I see that quite as dramatic. And even if there is a huge weighting in tech today, which there is, it's still diverse across a lot of different types of tech, and it's on tech with earnings. And by the way, as we'll maybe talk a little bit later, Maggie, in some sense, it's the only fundamental success story we got going on in the last few years, because much of the old line is not doing much.
Yeah. So talk to me about that dichotomy, because what and why is it important? Why are you tracking that?
Yeah, I've done a lot on this because, as you know, and as all investors know, we've had an extraordinarily bifurcated stock market bull run. We're a very concentrated bull run. One of the reasons we're talking about tech is because it's very concentrated, mainly in the information and communications services sectors. Doesn't mean the rest haven't gone up somewhat, participated, but they're really also rans in comparison to what this part of the market has done. And so it's always the question, why have we had such a bifurcated market? If you go back to the 2021 bull coming right out of the pandemic in 2020, that was a pretty aggressive bull run off the lows. And that bull run was the last one where the small cap stocks beat large cap. Mm-hmm. And really much of the broader parts of the marketplace beat tech. Tech did good, but it wasn't the only game in town. Now, we went into a bear market in 2022, and as we've come out of there, it's really been only tech or communications and information processing. The rest of it has been woefully left behind, whether it's small caps, whether it's mid caps, whether it's high beta, whether it's low volatility, whether it's international stocks, value, it's just all of it left behind. So it's a really bifurcated market. What led to that? And I of course don't know, but my guess is this story I'll tell. I think that as we got into early 2022, the Fed started tightening interest rates finally decided the economy was going to make it out of the pandemic and it was time to fight inflation. They were way late because inflation peaked at 9.1% in June of 2022. And the Fed started tightening, I believe, like in May, about a month ahead of that, or 2 months ahead of it, of the peak inflation. But they went after that. And what happened in 2022 is we had a huge surge in inflation, and then the Fed started tightening, and by pretty radically, they lifted rates up very strong. They inverted the yield curve yet before that year was out. Annual M2 money growth went negative that year in November, for example. Overall, they were shrinking the balance sheet, that $9 trillion balance sheet of the Fed. So there was a lot of aggressive tightening. At the same time, the dollar was going up, which is the tightening force. The fiscal juice of this economy got as high as 18% of GDP in 2021-22, and they took that down to about 3% by early 2023. So there's a lot of tightening policy. And we got back-to-back negative quarters in real GDP in the first 2 quarters of 2022. And now that's subsequently been revised, and there's only been one negative quarter, but there's still been a 6-month period of negative real GDP growth. Okay. Now, in the past, until just not that many years ago, when you had 2 back-to-back quarters of real GDP growth that were negative, that was a recession. That was kind of the rule. And we changed that a few years ago. Now we get a bunch of old guys and sit them in a room and say, "What do you guys think? Was that a recession?" Nah, I don't think so. And that's what they voted. And so it's never been declared a recession. But I think what happened in 2022 was, outside of information and communications, outside of new era, the old era economy went into recession. And because the Fed was fighting inflation, and because it looked at the large companies in this country, which most of them were tech, they were all doing great. And the S&P was doing great. It was going up, the new bull had begun. So they went, well, what the heck we got to worry about? It seems like everything's going okay. We're going to keep tightening. But I think a lot of the rest of the economy went into recession, and then they had a Fed and a fiscal authority for a while that kept tightening even though they went into recession. Just first off, I want to show you, this is the only bull market which started in October of 2022 that I've been able to find going back post-war history that basically has lived its entire existence under economic policy tightening. Now, I know we had a few months where the Fed eased late last year and where they just eased again, but aggregately, it's been tightening from the get-go. Most bull markets start when you're either in a recession or worried about a recession. And because of that, there's massive easing. That's what pumps it up to start with. In 2020 was a great example. That was a bull market that was birthed by economic policy easing. We brought it all: fiscal juice, monetary juice, lower rates, steep curve, everything we had. And that's generally how most bull markets start. And then as it progresses and matures, policy officials start to take the punch bowl away. This one is totally different. This one started under tightening and lived its entire existence under tightening. The Fed funds rate went from 0 to 5.5 over most of this period of time. It's still pretty high. Annual M2 money growth came out in 1960, Maggie, and year-on-year growth had never been negative until November of 2022. It was negative year, and then it stayed negative for 16 consecutive months. The yield curve, the Fed funds to 10-year yield curve, was in this bull market has been negative 89% of the time during this bull market. It's been inverted. That's just unheard of. The balance sheet of the Fed went from 9 trillion since this bull started to 6.5 trillion.
So why is that so significant for you? What does that tell you?
And the dollar also went way up, on fiscal. Well, I think that we've got an economy for the first time, which has kind of bifurcated itself into 2 parts: new era and old era. And I think new era has, its operating model has divorced itself from normal cyclical economic conditions, normal policy conditions. It doesn't need more money growth to grow. It doesn't need lower rates or a steep curve. It doesn't need fiscal juice. Its growth comes from internal operations, from internal creativity, from chronically and constantly creating innovation and delivering something brand new that the entire marketplace absolutely has to have. And if that's the case, monetary, fiscal, dollar, and the normal cyclical inventory cycle and everything else is irrelevant to the operation of these companies. Now, we're still learning what is relevant, and it comes down to understanding what drives innovation cycles, because that's what drives these companies. I don't know the answer to that. I've been spending more time on that subject. I don't think I've seen anyone that really knows that. We all have our cliches. We throw out productivity, cash flow, investment, but no one that I've seen have actually got a good cyclical model for what drives these innovation cycles. So it's off doing its thing. And the rest of the economy, because of tightening, fell into recession. And I ran these charts earlier in other Substacks. If I take Russell 2000 back to 1995, and I overlay the employment of the Russell and the employment of the S&P 5, they both go down in 2000, come back up. They both go down in 08, 09, come back up. They both go down in 2020, come back up. Then 2022 hit. The employment in the S&P 500 went flat for about 2 months, and then it went straight up ever since. And in the Russell went down and has never really come back. Okay. If I think for Russell earnings or sales, you get the same thing. They used to move together with the S&P 5, and then since 2022, they've gone south, and S&P 5 are since going back historically. Corporate profits in this country are below trend line right now, but S&P profits are above trend line. That is to say, the S&P has been doing great. Much of the rest of the economy hasn't been doing for the first time. And so I really think we got this thing where we're tightening, which is keeping a big chunk of the economy in a recession for the whole bull market, more or less. It also explains how, when we have the stock market at record highs and we still have GDP that's positive, how can we have so many people so pessimistic? Small business confidence has been in the tank until really this year, the whole time in this bull. Consumer confidence went down in 2022 and has never really come back. It's just laid down there at what would be normally recessionary lows. There's been a big divergence between CEO confidence and small business confidence. CEOs have held up better than. My point is, I think, why is confidence so bad? Because most consumers in this country work for small businesses or mid-sized companies, not large, and they're not doing all that well. And so they're kind of pessimistic about it. So how do we reconnect the economy is kind of the question. And can we? I think it could turn out a few different ways. Maybe the innovation cycle rolls over for tech and everything falls into recession, in which case the policy juice will come. Okay. But I think more likely is that innovation cycle is not yet done and it's going to keep on for a while. But the economy's gotten slow enough now, finally, with this much big chunk recessing. The unemployment rate now has been rising for the last 2 years, which never happens in expansion. You can't find another example of that. That's been going on. The GDP growth in the first half of this year is up a little over 1% in real terms. Employment growth through August year to date is up at a 0.6% annualized pace. These are levels of real growth that are just getting too low to ignore. And so I think we're going to bring policy juice. And you can see the discussion already changing on this.
Yeah.
And I think it's foolhardy to think we're going to get a runaway inflation when real growth in so much of the economy is weak as it is.
So is it possible against this backdrop that you talk about that you can see the innovation cycle is in its own world and still humming, but you see the neglected other parts of the economy and stock market start to get some help? So whether it's the passing the baton or that gearing up and both of those things moving higher, you could have this really bullish scenario, even though there's all this worry about a bubble. Is that right?
I think so. And I guess that's where I lean. I think that tech, one of the things that's risen tech's values is not just its own fundamental performances have been so good. That's true, they have. And that's increased their valuations. I showed in my recent reports that tech and communication services PEs, trailing 12-month PE, has gone from something, I can't remember the exact numbers now, a decade ago, 15 to 36 times or something like that. They're definitely up, and they're about as high as they've ever been. Maybe not quite as high as .com, I don't know, but about as high as they've ever been. And part of that is just because they've done so well with their earnings and sales, okay? That demands higher multiples. But I think the bigger reason why it's done so well is they've been able to do this in a world where nobody else is doing good at all.
Yeah. And
you think about it, if you're doing well, you get rewarded in the stock market. But if you're doing well alone and nothing else out there is, boy, what is the value of that? It's almost infinite.
So it's not irrational that we've seen this huge concentration in those stocks, because they are simply outperforming everyone else based on real fundamentals that are disconnected from the rest of the economy, but they're their own fundamentals. Is there a scenario where even if that starts to slow, the AI productivity benefits transfer down to some of these small and mid-sized businesses and they increase their speed, even if you start to lose a little velocity with the AI bubble?
I think that my guess is the tech space probably underperforms if we bring policy juice to the party. I think if we bring full-fledged policy juice, if the Fed keeps easing interest rates, mortgage rates will fall, long-term bond yields will fall, money growth will pick up, the dollar will come down. Some of that's already starting to happen, and that will juice a lot of these other parts of the stock market that have not had all that juice they normally get. And I think they will lead. And I think tech probably trails, because if the rest of the parts of the economy start to pick up, then some of the appeal of tech is lessened. Even if their fundamentals are the same, they're not worth as much. Because
right.
On a basis.
It's priced in. It's priced in already.
That's right. If the innovation cycle stays in force, I think tech continues to participate. It just finally trails maybe for a period over the next few years, while some of this other stuff, juiced by policy, will actually do what it normally does. It when that happens, it outperforms. Now, you could get bad scenarios where there's people run really fast out of tech if it starts to underperform, and you create a crash or something over there. That's a possibility. But I think it's reduced by the fact if other parts of the economy and the market are doing well, there's not going to be as big a panic.
Yeah, that's really interesting. One of the things I like about this conversation, Jim, is that we're talking about it from a sort of economic point of view, and not from I'm a futurist, believe tech is going to save the world, or I believe that this is a Ponzi scheme, run by a few of these tech wizards that are overvalued. There's a lot of sort of emotion in the argument, and this kind of strips it away and thinks about it in a kind of different economic lens, which I really appreciate. Doug is asking, is this bull market being caused by excess liquidity feeding on itself?
I think that I think the bull, there is some of that. I think the bull that's been driven is mainly confined to fundamental drivers. It's, as we've talked about, it's mainly in those areas that have gone up. The performance of the X communications and information processing sections of the S&P 500 in this bull have been pretty minimal. Okay, most of it's been in those areas. For example, the Russell 2000 just took out its 2021 high. Large cap value, I don't even think quite has done it yet, for example. And that's sort of the story. I think that if I look at the performance of the S&P X communications and information processing, it hasn't done that much. So I would say most of this market is driven more by fundamentals than by, a fad or great positive emotion, at least so far. Overall, I do think that there is a lot of liquidity out there, but most of it's being hoarded. We've got $7-8 trillion of money market funds, which is pretty close to a record high relative to disposable personal income, that's being held. And I haven't written a lot about this, but it's on my board, but I've got a lot of fear assets that have done really well in this cycle. So, money funds have done really well in this bull cycle. Normally, you have the stock market going up like this, you wouldn't see that much sitting in money funds, but they are. Cash holdings among companies are very high. They're not necessarily being used. They're kind of sitting in reserve overall. I'm looking at things like gold doing spectacular in a stock bull market. I'm looking like crypto doing great in a stock bull market. Looking at money funds doing great in the stock bull market. And I'm thinking that this is kind of a fearful bull. That is kind of what has played out. And it's really, it's not only weird, it's unprecedented to have U.S. consumer confidence at close to all-time post-war lows. At the same time, the S&P 500's at an all-time record high. But that, to me, reflects that dichotomy. And I think it ties into what I was saying earlier. The vast majority of the economy has not done well, and they are hoarding cash. They're keeping their debt loads low. They're keeping their debt service down. They're all ready for a recession, because during this bull, how many times have Jamie Dimon told us that there's going to be a recession coming?
Yeah.
And so people have been, I think before this thing finally does end, and there really is an emotional blow off and risk in the market, I think you're going to see a lot more optimism in general.
Are there sectors that you like that have been neglected that look like they will be the first to potentially become leaders?
Well, I think that, to me, there's quite a bit out there that's been neglected. And so rather than pick that one that's going to be go to the moon, I would continue to own tech, but I'd move to an underweighted position. I'd start to take myself not out of the new era, but I'd underweight my new era position, and I would overweight old era. And I guess I do like small caps. I think you already see in that space that the cap is starting to outperform from the bottom side up. That is to say, micros have moved first. Really, the IPOs have moved first, then micros, and now smalls, and mids have not yet moved on a relative basis. But I do think caps moving from the bottom up, and I kind of like moving your cap space down. I'm okay with mids, but I'm really like smalls, I think, the best. I do like international, because I think the dollar's coming down now for the first time, and I think it's going to come down even further. It's still higher than it's been about 80% of the time since it floated in 1970, and rate structure is still too high. So I do think that there's some good possibilities there. And I don't, if I had really strong conviction about industrials over consumer discretionary, I'd say I don't. I'm going to own some, but I don't think I'd single out any one. I'd just take a good spattering of some of this old era, and I'd put things in there like value. I'd put things in there like high beta. I put in some low volatility stuff, and ride more of those now going forward, rather than picking that one best sector.
Yeah, it makes sense. And Paul, I think that answered your question. You came in a little late about what is old era and new era. In a way, it's hard to find anything that's not going to intersect with AI. But I think Jim's referring to just traditionally sectors that everything else has been left behind. So as you just heard, value, industrial, small cap, anything that has been kind of lethargic and lingering here as AI and the Mag 7 have sucked all the oxygen out. Jim, the last thing I'll ask you about before we go is jobs, the labor market, because this is one, I think this is part of what has people feeling pessimistic, that concern about, will my job be there? And there's not an AI conversation I have that doesn't come up. And I've seen some pretty shocking predictions out there about wiping out generations of workers, wiping out white collar workers. Are we paying enough attention to the jobs market, and is that a worry for you?
Well, I share some of those worries some days. I can convince myself that AI and robotics and some of those things are so dramatically transformational that, what are we all going to do if they can do it all? I mean, you and I both write regularly, to some degree. If Chat GDP can write whatever I got to say better than I can, I don't know what are we going to do? Robots can look a lot better than I do someday. So it does sort of scare me when I think through that, about where that goes. Do we all just become capital owners and eat grapes on our couch while everybody, all the robots and AI takes care of everything else for us? I doubt it gets to that. And so I kind of suspect that, like other innovations in the past, that this stuff is going to create its own demand for jobs. And I do think that's the case. I think what we should focus on in this country is getting more labor resources in here, not fewer. Our growth rate is really slowed down dramatically, even in the new era economy, because even the new era is cutting jobs because of productivity. But I think one thing that could help the situation is if we get more people in here I think we'd have, with greater resource growth, we'd have greater broad-based growth in the economy, and there'd be more opportunities for people. I don't understand an economy that's growing sub 2% or thereabouts of not welcoming greater pockets of immigration. And I don't even talk about the politics here. I'm just the sheer desire to have greater growth in this country economically for us all to enjoy. What we should do is lower interest rates, stimulate growth, because we don't have a lot of it outside of the tech. It isn't going to affect tech. And I think we should do that and then bring more resources so that they help us drive the growth rate. We're keeping the dollar too strong. We're keeping rates too high. We're keeping money growth too low. All of this weird fear about inflation because somebody came up with this artificial 2% inflation target as nirvana. I think it's a mistake. I think we should look at promoting faster growth because our birth rates are falling and our immigration are falling. And that's going to be our bigger problem. Not so much that we have too much of it, I think, is my guess.
Jim, awesome stuff. Thank you so much. It's such a great way, I think, to look at this, and a great way for us to all think about what this means. So I love catching up with you. Appreciate you.
Well, I'm trying to figure it all out too, everyone. So
well, and that's the most honest thing any of us can say, right? I think we understand that, we're at an inflection point, and there are a lot of unanswered questions, but asking the right questions to find those answers, I think is the way to go. And we appreciate you doing that. As always, we put a link in the description where you can find Jim's fantastic Substack. Thanks to everybody for starting the week off with us. Just a programming note, I have another event where I'm going to be talking all about AI. So I'm not going to be with you Wednesday, but we've got some great fill-ins. Jeremy Schwartz is going to be with Jim Bianco. So be sure to join us for that. In the meantime, everybody, take care and good luck out there.
Thanks.